Well, good afternoon. Thank you for taking the time to let me share with you my mid-year client update titled Inflation. Today's webcast is being recorded and will be available for replay following the webcast. Note I'll be planning a year-end webcast that will include a 2023 outlook in mid-December. If you find today's content helpful, be sure to register when the invitation arrives in your email box come early December. Also, if you'd like a copy of today's presentation slides, reach out to me following the webcast. As a reminder, today's content is designed to update my clients who include institutional investors of our fund, Concilium Capital, qualified plan sponsors and their participants, as well as high net worth and individual investment advisory clients. Now, with those housekeeping items out of the way, let's get started. I suspect the title of today's webcast is a little unsurprising as to the focus of my content. We're all seeing and feeling the effects of inflation everywhere we go. And you likely understand that the causes of today's inflation are a little different from the past in some important ways that I'll plan to discuss. But first of all, let's define inflation. And I think Milton Friedman said it best. I get my slide to advance. Milton said, inflation is always and everywhere a monetary phenomenon in the sense that it is and can be be produced only by a more rapid increase in the quantity of money than an output. And if you think about what's transpired in the last 24 months since the beginning of the pandemic, we went through a shutdown, the economy shut down in most parts of the world, and then governments respond very quickly with vast amounts of fiscal responses and stimulus that has produced a big jolt in the supply of money floating around, while we simultaneously still have supply chain problems and even geopolitical issues in parts of the world that's creating this dramatic inflation issue that central banks are now trying to deal with. But nonetheless, fundamentally, I think what the definition of Milton Friedman spells out on this page for us is completely accurate. We've got too much money chasing too few goods at the moment. And if we think about the fiscal stimulus part of it, I've shown this slide in an earlier webcast. If you think about just taking the United States, for example, we spent just on COVID-related stimulus in the last 24 months, a little over 26% of our GDP. In dollars, that's a little over $6 trillion. Just to give you some perspective, we spent in the Middle East after 9/11 about the same amount of money, but that was not over 2 years, that was over 2 decades. So as you can see, it's a huge amount of money that's entered our financial system, and there's, again, lots of money chasing goods that are not available. What's also interesting is if you look in other parts of the world, there's other countries that actually did more as a percentage of their economies than we did. So for example, Japan spent 56% of their GDP, twice ours, on COVID-related fiscal measures. Germany also spent close to 50% more than us at almost 40% of their GDP on COVID-related stimulus. And I point out those two for a reason. Those are two established, developed economies that actually have much, much lower interest rates than we do. And I'm going to speak to the interest rate environment that we're seeing right now in the United States and the expectations for it as part of this presentation. Also, another question that's probably on a lot of our minds is this inflation transitory, or is it going to be more secular or long-term in nature? And if you look at the correlation to the money supply, which is what you see here on this blue line, it's year-over-year change is what we're looking at. And then you look at, with a 3-year lag, the year-over-year change in the CPI index, which is the broadest measure of inflation, which you can see is that there's definitely a correlation there. So when the money supply spikes like it has, as a result of the COVID-related stimulus, it does beg the question, are we going to see a commensurate spike higher in the inflation data? I would take exception to that possibility of inflation getting up in the 20 to 25% range, at least in the CPI readings, mainly because in no other time that's on this data set that goes back 60 years, did we first shut down the economy in order to experience such a deep economic contraction first that justified to some level that stimulus. In other words, the stimulus, the inflation readings rather, that were going on in the 70s and 80s that I got to hear never saw stimulus measures that came along creating money supply growth. So I would just say my expectation is not to in fact see the 3-year lag CPI change get remotely high as this year-over-year change into money supply. But looking at the CPI index, and particularly in the light of historical recessions, the reason why I think we see recessions around these high inflationary readings is not going to be of surprise to a number of you, mainly because you usually are seeing governments start to restrain themselves in terms of their fiscal policies, which we are in fact seeing. But you also see with that, which is another thing that we're seeing, central banks start to reduce their loose stimulus policies in the case of more recently for us, and start getting far more tight with monetary policy. So we're seeing that, and we'll explore that in more detail. But again, another thing I want to point out to today's inflation readings and the headline CPI is that it has broken out to a new all-time 30-year high, but we are not yet, in fact, anywhere close to the 70s and 80s inflation readings that we saw back then that led to double-digit interest rates. Let's talk about central banks and what they did during COVID and then what they're doing today. So we're going to look at the combined balance sheets of the Federal Reserve, the Bank of Japan, the European Central Bank, and the Bank of England. And this orange line represents their combined balance sheets. So when you see when we went into the pandemic and governments authorized these huge amount of fiscal deficit spending, that money didn't have to get floated out in the market for investors to buy, because the vast majority of it was monetized onto the balance sheets of central banks. We call that debt monetization, at least indirectly. So that's what helped spur the quick recovery, was this dramatic increase, which totals over $5 trillion in the collective balance sheets you see listed there of those central banks. And now, of course, you're starting to see that reverse as the inflation data has been coming higher, no longer looking transitory. The other thing that we're seeing simultaneous to that is also the interest rate increase in the federal funds rate in the case of the United States, and the other central banks doing the same thing with their short-term overnight borrowing and lending rates. And so this is a double approach to tightening policy. And to give you some perspective, we are witnessing a tightening of monetary policy today that's much quicker than any other time since the financial crisis ended in 2008. I think that largely speaks to the disruption that we're seeing in financial markets, which also begs the question, when are central banks going to stop tightening, or at least stop tightening as much? And I'll speak to that a little bit later. If you look at the impact that it's having on real economic growth in the United States, this chart is showing you the Atlanta Fed's Real GDP Now tracker. It's one of the more real-time data sets that you can locate that will give you as close to real-time of activity as you can find. And as you can see, going back to just as recently as the end of April, real GDP in the United States has been trending towards the zero bound, which is where we are about as of the middle of June. So the Federal Reserve and other central banks around the world are in fact getting growth to slow down. The question is, when will inflation come down with it? So much of the inflation data we're seeing is commodity price related inflation that's well outside of their control. But if they're creating enough demand destruction through tight monetary policy, you will in fact start to see things like gasoline consumption come down, diesel consumption come down, which we're seeing. But you can't do a whole lot about food price inflation. And the only thing you can do about wage inflation is to try to cause unemployment, which is not a good thing in the long term, but I think that's going to be the end result. But be that as it may, we are seeing a slowdown in real GDP growth. Nominal GDP growth is still ticking positive, but that's largely due to the inflation effect. So what has all that meant for stock and bond price movements year to date? Well, if you look at the year to date results of a typical balanced portfolio that's in the S&P 500, as well as in some of the more investment grade bond universes like the Barclays Ag, it's not been a pretty start to the year. Matter of fact, the only other period of time going back to the late 1970s that had the worst start was really the 2008 financial crisis. And the real estate world, the financial system, nothing is like today what was going on in the 2008 financial crisis. Really what explains what's going on is the inflation and the fact that we started with such low interest rates at the beginning of the year, and also simultaneously relatively high valuations historically in the U.S. stock market. The good news is, though, I do think there's a reasonable chance we'll see some recovery the back half of the year, and I'll talk a little bit more about that in a few more slides. But let's focus on for a minute why the stock market's gone down, because I know many of us think of the stock market over a longer period of time is an inflation hedge, and it is. But what happens is when you see inflation go up very quickly in a short period of time, you do expect interest rates to go up. And most people know that when that happens, bond prices go down. But what can also happen is investors can require a higher earnings yield to go up for investing in equities to be commensurate with the increase in interest rates. And so that does explain to me why equity prices are down, because investors are now expecting higher earnings yields out of equities with this higher inflation reading that you see here in blue. So clearly we're in a bear market with regards to U.S. equities. I say that just because our industry, for some reason, has chosen the 20% decline level as the decline that defines a bear market. So I think it would be useful just kind of put in context some history for you. You know, what's the average length of a bear market? What's the average decline of a bear market? What are bear markets that were shorter in duration and decline less? What are bear markets that historically were longer in duration and declined more than what we've seen thus far? Let's just look at the average. If you go back to all the bear markets going back to the Great Depression, the average length was 14 months. So far we're in month 6 so far of this one. The average decline for a bear market is 36% from high to low. The S&P 500's been down 26% from high to low at the start of the year. Clearly, there's bear markets that were shallower than that and less time consuming that you can see mentioned here in terms of the number of months, as well as over here in terms of the number, the percentage of the drop rather. I think to me, what I think about what's probably the closest to bear markets to what we're actually experiencing is both the 73, 74 bear market, which actually ran 21 months. And the reason why I look at that one is that that one was based on oil prices going up a whole lot over a very short period of time. Some of you might recall the Arab oil embargo when oil's gone from basically $4 a barrel to $40 a barrel in under 24 months. And that put the economy in recession because the central bank was having to tighten monetary policy as well. So we saw a 50% drawdown in the stock market, and that even took the energy stocks down with it ultimately. Over here in my other example, I think there's a correlation that we ought to be thinking about to when the tech bubble burst in the year 2000. We saw a basically almost 3-month bear market that took the S&P 500 down 50% roughly. During that time frame, tech stocks will go down closer to 86%. But in that period of time, we didn't have the commodity price inflation that we're seeing today on the front end. That was really just truly the bursting of an equity market bubble and monetary policy tightened. And as a matter of fact, in that 3-year bear market, you saw the US economy grow 14% despite the bear market. So I think it's fair to say we probably got some combination of the two, which is just to me to suggest that this bear market's probably got some room to run, both in terms of its duration, but also in terms of its drawdown expectation. That sounds like bad news, but let's talk about some near term, what could be good news. If you look at what can happen the back half of a year like this year, this is a chart from Ned Davis Research that just combines cycles based on a 1-year seasonal cycle, a 4-year presidential cycle, and then a 10-year decennial cycle. And what you see in this orange line is what's actually happened in terms of drawdown of the S&P 500. And then the blue line is just taking an average of those 4 cycles historically and what tends to happen. Now, I wouldn't put a lot of your eggs in this basket in terms of expectation, but I would say just because on average you do see history suggest that you might get some market recovery the back half of a year after a pretty dismal first half of a year, I would say it is reasonable, particularly if interest rates peak and start to trend lower and energy prices peak and start to trend lower the back half of the year, which is actually my expectation. Let's talk about interest rates. Why could interest rates peak and trend lower the back half of the year, particularly when they're so low in light of the inflation data that we're seeing? Well, let's look at interest rates from a longer term perspective before we talk about that. If you look at the 10-year Treasury yield going back to 1958, you can see we're really at the lower end of the range. And we're nowhere near, thankfully, the high end of the range that occurred in the early 1980s when we had all the inflation in the 70s. This gray line is showing you real interest rates. In other words, the interest rate you're receiving after inflation. And of course, you really are getting penalized holding fixed income securities right now after inflation because inflation is so high. So again, it begs the question, why in the world do I think interest rates could be peaking as we speak, particularly with the 10-year that's gotten up to only 3.5%, while inflation readings are still at 7.5% to 8% the back half of the year? And really the answer is pretty simple. It's debt. When you look at the debt of the US government in the United States, and even outside of the government's debt, when you look at the private sector debt levels, it's still a historically high level in relation to the size of our economy. That's also true in other parts of the world like Germany and Japan, which I think explains why their interest rates are so much lower than ours. And if you look at this in some historical context, which you'll note, which is not on this chart, but what is on this chart is debt in relation to the federal government's debt in relation to the size of the economy at that moment in time in history, going back to the 1940s. And if you go back to the 1880s, what's interesting is you go back that far, you see the 10-year treasury never get above 3.5% from 1880 to 1950. So that's a 70-year period of interest rates not getting above 3%, and we've gotten above it a little bit lately. Well, what was keeping interest rates low during that 70-year period of time was the debt level was high. We had a financial crisis that led to a slight depression in the late 1800s. We had the Great Depression in the 1930s, followed by a lot of war spending going into World War II. And so you see that when you see historically high debt levels at the government's level in relation to GDP, you generally tend to see low interest rates with 3% being the upper bound. And if you look at the forecast from our own Congressional Budget Office, they're forecasting that the federal government's debt is going to trend a little lower, but ultimately be higher by the year 2032, which again just tells me that the government's going to need low interest rates in order to keep its finances, in order to keep the promises that it's made on things like Social Security and Medicare. And I think the central bank will be involved with helping to keep a policy in place that affects that. To put it in terms of us individually, imagine you've got too much credit card debt and your credit card company calls you and says, hey, we need you to speed up the paying down of your credit card debt. Well, if they tell you to do that and they raise your interest rates on you, they've just slowed down your ability to do so, all things being equal. So again, I think we're going to witness an environment where we could very well be seeing the peak in interest rates this month, and it may trend lower the balance of the year. Does anybody agree with me? Well, let's look at the yield curve and the investors that are buying longer duration debt from the US government currently. If you look at the yield curve at the end of May, what you see is that investors are willing to lend the United States government money at a 3% rate or less all the way out to 30 years right now. So again, what the Federal Reserve controls is the short-term policy and only the short-term rates with their overnight Fed funds borrowing and lending rate, which is what they're raising. And they're going to continue to do that next month before they pause in late July and early September. But the point is, again, on this chart, when you see this flattening yield curve, that's an indicator of a couple of things. Number one, long-term fixed income investors are not concerned about the high inflation readings. And two, it's telling us what we've already gone over, which is economic growth is falling, and it's falling at a very rapid rate. So it wouldn't surprise me that if in 12 or 18 months, we actually see the yield curve go back to looking very similarly to what it looked like at the beginning of the year, which is what this gray line represents at the end of 2021, where the long-term rate got back down to just under 2% and the short-term rates get back down below 1. What will cause that is obviously more slowing of an economy, but an assumption also that oil prices and commodity-related and wage-related inflation starts to moderate as well, too. All that's just to say that, again, I think bond prices are attractive here. Why else do I say that? I talked about earlier, looking at the interest rate differences between the United States, Germany, and Japan. The green line is the cost of the US government in terms of the 10-year borrowing costs. So in real time, that's up around 3.5%. As I was saying earlier, there's this huge spread. Notice Germany's 10-year government borrowing cost is only at 1 point, just today in real time, it's about 1.7%. But look at Japan's. It's at 0.25%. And I bring these three countries up because they've got the same inflation readings that we're seeing here. yet their government bond yields are so far below ours. Well, what's the takeaway? Well, imagine that we're all part of an investment committee on either a German pension fund or a Japan pension fund or an insurance company or a bank, where we've got some pool of capital that's reserve capital that's got to stay in safe, liquid, sovereign debt. Which sovereign debt market are you going to choose for that portion of our capital? And I think the answer ought to be pretty clear. You're going to be looking at the US debt market, because even after currency hedging costs, you pick up a pretty good yield spread relative to the alternatives being Japan or Germany. Now, let me switch gears and go back to some things I was saying prior to the pandemic starting a little over, 2.5 years ago, I guess it's been now. And some things that are starting to unfold in a very similar fashion, which were these trends that were going on both in the decade of the 90s and then also as well after the 2008 financial crisis ended through the end of 2019. The first time I put this chart together was actually around the end of 2019. And what I was noting was the following that you see in bullets. Number one, in both of those decades, we didn't see a recession for 10 years. That's historically a long period of time. If you go back far enough, you can often see recessions as frequently as 3 to 5 years to 5 to 7 years. But in these two particular examples, we didn't see a recession for over 10 years in both decades. What's also interesting about these two decades is that US equities performed far better than non-US equities. And that was mostly due to the US technology sector outperformance within the US stock market being what explained it. So by the end of both decades, the market cap of the technology sector would drive the weighting of technology stocks in the S&P 500 index to around 28%. That's a historically large weighting for any individual sector. And that usually has meant historically that that sector was reaching a bubble peak, that it would influence ultimately the entire sector because it was such a large part of it. What was also interesting about the end of these two decades was that the energy sector would be among the smallest of the weightings because its market cap by sector had gotten so small as a result of falling commodity prices. It was around 2% of the end of both decades. The fourth parallel that was going on in both decades was that the dollar was strong. Why is that relevant? When the dollar was strong historically, that's great for US consumers. In the United States, the US economy is 70% based upon consumer spending. And so when the consumer's purchasing power is going further, that's good for the US economy. Fifth point that's tied to that, commodity prices were falling in both decades, which was good for the consumer as well. But that one of the things it did is it also allowed monetary policy to be more accommodative than it would have been otherwise. And this promoted asset price appreciation during both of those decades. Well, here's what I was assuming at the end of 2019, not knowing that in 3 months we would be in a pandemic-induced global shutdown, was that it would seem reasonable to me that since in the decade following the late 90s, you'd see each of these trends reverse, it would make sense to me that we might see that happen again this decade. So in other words, between 2020 and 2030, it would seem reasonable to me that we'd probably see a recession. Well, we got that because of the shutdown. You would start to see US stocks start to underperform non-US stocks. We've not seen that yet, but it looks like we're getting close. You'd see tech stocks start to underperform. We're starting to see that as of this year in 2022, and you'd start to see energy stocks start to outperform, which is in fact happening commensurate with commodity price inflation going on, which again, we're seeing that go on as well. So these are some things that I want to now explore in a little more detail again with you as to where we are in more updated charts and what I think in terms of the runway here and the timing. But let me first go back in history and talk to you about when stocks are up historically. What percentage of the time in a calendar year should we expect US equities to be up? I like to go back as far back as I can when I look at data. So this particular chart is as far back as I could go. It takes me to 1833. That's good enough. And it happens to show who's president when the market's up or down in that particular year. And here's what we know. 2/3 of the time, if you go back to 1833, you can expect the stock market to be up, which also means 1/3 of the time, if you go back that far, you should expect it to be down. What's interesting, though, is much more recently, we've had far more up years than 2/3 of the time. So, for example, if you look at in these 16-year periods that I've got boxed for you, you actually only saw between 1985 and, the year 2000, 2 down years, which meant that the market was up 89% of the time versus 67% of the time in that time frame. The only other time that's occurred was more recently between 2005 and the end of 2020. It actually would be higher than that if we include 2021. But I also like to point out, notice that 2003 and 4 were up years. That's now 17 out of 19 years where we had positive returns in the US equity market, meaning that 91% of the occurrences in recent history that encompasses most of our investing timelines for a lot of us has been a positive up year, and we're now biased towards that. And my only point of putting this up in front of you before we talk about the near term is if the 2/3 rule that goes back to 1833 is going to continue to hold true, we know we got to have some down years more than this year, ultimately in the US equity market, because we've had a string of so many up years in a row. Which begs the question, now that we've had a pretty nasty start to a down year, is the US equity market cheap? Well, let's look at a valuation metric that'll help us answer that question. If you go back to 1997 and you look at the forward price to earnings ratio, which is what this black line represents, you can see that it's come down quite a bit. But what I would tell you is that we're actually at the upper end of the fair value range. We're not yet at the lower end of cheap, which is where we got in 2008. That's not to say that equities are expensive. It's just not to say that they're cheap. And that doesn't mean that equities can't rally the back half of the year. Number 2, are there pockets of value to find within our equity market? And the answer to that is yes. We see historically these periods of time where value stocks underperform growth stocks and vice versa. In the 90s, you saw growth stocks way outperform value stocks because growth stock indices tend to hold the technology sector. And then when you saw after the tech bubble burst, you tended to see the value indices outperform. Why do we see that? Because you tend to see the more commodity intensive or benefiting stocks outperform, such as the industrials, the materials, and the energy stocks. So when you see on this chart, which is a ratio between the value and the growth equities over time going back to the late 90s, just understand that when the trend is going up, value is outperforming growth, and the trend is going down, growth is outperforming value. Well, here we are, at the early part of this year, showing the latest reading at the end of the first quarter. Value today is historically cheap relative to growth. And if we're going to have commodity inflation that runs this entire decade like it did most of the decade of the 2000s, it just suggests that value stocks will fare well relative to growth stocks, and that's a place to consider owning some of your equity exposure. Where else is there some relative value? Well, let's look at international equities for a minute. This chart is basically showing you when internationals outperform US in gray and by how much and over what period of time. And then in purple, you're seeing, I said it the other way around. Gray is showing you when US has outperformed non-US in the length of time. Purple is showing you when internationals outperform US and by how much for the length of time. So for example, in the 80s, international outperformed the US stock market, but almost 400% for that 6-year period that you see there. I just want to point out more recently, notice that international has outperformed US for over 14 years to the tune of 262%. So the question is that going to be indefinite, that US keeps outperforming non-US? I don't think it will. Nothing tends to outperform indefinitely. Why do I think that'll be the case? Well, if you look at the discounts in terms of valuation that international equities offer in terms of cheaper valuations and better dividend yields versus the US, it just suggests to me that if you're going to own stocks in a diversified portfolio, you definitely want to include not only value stocks that are going to give you some inflation protection, but you also want to include some international equities because they should have better protection against inflation, but also further equity drawdowns too, should we have to sit through them. Let's also talk about inflation hedges in general. We know that the inflation we're seeing is largely driven by two things: commodity inflation and then the wage inflation. So if you look at the performance of these asset classes that we tend to see, investable asset classes over a long-term time frame, this is 1970 to 2020, 50 years, and you look at the performance of these asset classes over that entire 50-year time frame, you can see that stocks do give you a good inflation protection. And tips in terms of Treasury inflation protected bonds can as well as REITs and high yield bonds. And commodities can as well. But notice what happens if you get into an environment like we're in now, where inflation really shoots up dramatically. And so you want to own commodities for sure, because again, that's what's driving a lot of the inflation, which includes gold, which I'm going to spend a few slides talking about gold because it's not risen as much this year and really for the last 2 years as commodity prices has. But notice all of a sudden you get a negative correlation, which is easy to understand with interest rates moving up in the bond market, but then also you'll see a negative correlation to the stock market in general, to dramatic increases in the inflation rate. So all of a sudden stocks are not acting as a protector against inflation when you see these dramatic increases in inflation like we've recently experienced. So that's just simply to say that portfolios that have inflation protection through commodities and gold can help offset the declines in fixed income and equities if we were to continue seeing these dramatic increases on a year-over-year basis in the CPI index. Within commodities, we know that one of the most obvious ones is energy. And I'm getting questions now about, should I be buying energy stocks? Well, I'd say not compared to 24 months ago. Why? Well, 24 months ago, oil prices were down around 20 bucks a barrel, and now they're up over almost sixfold, over $100 a barrel. And as I said before, I'm seeing signs that oil prices are starting to what could be topping out, or at least not moving higher. That's not to suggest that I think we're going to get back to $2 a gallon of gas at the pump anytime soon, but I think it is reasonable to suspect that the energy sector is responding globally to this increase in prices through providing more supply. You're also seeing demand destruction by changes in driving and consumption coming down as well due to the high prices. So I would just say that today the takeaway is that energy stocks, in my opinion, I wouldn't be making big additions to, but I'd keep them if I had them. But I wouldn't preclude me from buying small regular purchases if I'm a participant in a 401k program, for example. But if energy prices do come back down and correct, say back to $80 a barrel or $60 a barrel, should we get in a recession in the next 24 months, I'd say, yeah, at that point, that would be a favorable entry point. Because again, the trend could very well be like we saw after the end of the 2002 recession, a pretty substantial run that lasts for a substantial period of time. The argument for that, by the way, is one of the things that I follow is the active rig count. What's the active rig count? That's the number of rigs out there drilling and servicing oil wells. So when you see this blue line go up, which is where we were at, 2013 through 15, when we saw a lot of fracking going on in our country, notice that we're nowhere near seeing the number of rigs out there in the energy fields of our land drilling and servicing oil wells like we were. But the good news is that we are seeing globally production of oil kind of lining up more squarely with demand. And again, my expectation is that demand for oil is coming down with the prices being high. Let's come back to the subject of gold. I mentioned to you before, gold's a commodity. Gold should be responding to inflation, yet it hasn't really this year. And it's really been trending sideways, not only for the last 2 years, but as you can see, really for the last, going back to 2011's peak, when gold was last around just under 2,000 an ounce, we really hadn't seen gold make any meaningful progress, which begs the question, is it an inflation hedge or is it a good inflation hedge? I would argue that it is. If you go back over the longer period that you see on this chart to the year 2000, when the tech bubble burst, and you look at when gold was last at around, I think at that moment in time, it was around $250 an ounce, and you compound that price out to today's value, which is around I think it's around $30 an ounce as we speak. That's almost a 9% annual compound rate of return. What's interesting about that is that from that moment, 22 years later, you've actually outperformed being in the stock market. Obviously, you've not outperformed it in the last 24 months or even in the last decade, But if you have a longer term belief, which I do, which is that we're going to have to see interest rates stay below inflation for an extended period of time, that tends to be a favorable environment for gold price appreciation over the longer term. It also is a favorable environment for commodity investing in general. It also tends to be an environment where interest rates have to stay low and repressed. So to the extent you're looking for homes to both invest capital that might be in fixed income and or hedge against rising inflation, I think gold still has a very good argument there as a role there in the portfolio. Now, there's different ways you can own gold. You can obviously own it physically. You can own it in a lot box. You can actually own it in your brokerage account through an ETF. You can also own the gold mining stocks, which is my preferred method for clients, just because today they're still trading at such huge discounts to the price of the underlying metal. Today, for the average gold or silver mining company to get where it historically traded on average going back to 1987, relative to the price of gold currently, those stocks need to go up over 100%. Does that mean I know they're going up 100%? It doesn't, but I'm just telling you that to give you a parallel to the energy sector, it would be like Exxon and Chevron still trading at the prices where they were trading at 12 months ago, yet the price of oil would be over $100 a barrel. That's kind of where the precious metal mining stocks are trading today. And what often happens is that when you see the precious metal miners move very quickly, it's often around the end of a monetary policy tightening cycle, which does beg the question, if the Federal Reserve and other central banks are one interest rate or two interest rates away from hiking or making their last interest rate hike, which I think is likely, I think you very well will see between now and the end of the year, the precious metals companies rally pretty substantially relative to where they are today. What kind of returns does that industry tend to offer during stagflationary environments, which is really what I'm describing that we're in and may stay in for an extended period of time? Well, if you look at periods where we've had, for example, in the 70s, stagflation, gold would go up almost 30% per year, silver would go up a little over 30% per year, and the mining stocks would go up at around 20% per year. If you look at other periods outside of just the 70s where you had stagflation, which included the decade of the 2000s, the miners would do far better. They would go up at an annualized rate of return of closer to just north of 30% per year. So again, when I think about equity exposure to recommend and employ for clients, the reason why I continue to look at this space is because it's the cheapest. It's got the most favorable, in my opinion, underlying commodity that's got the most upside, and the valuations of the underlying stocks are the cheapest in relationship to the commodity that they're ultimately mining and selling. So in summary, what do I think? If you think about the economy in 2022, this is one of the things I said at the beginning of the year. Because of less or lower year-over-year fiscal and monetary stimulus to the tune of 3% of GDP, I said I felt like the private sector was going to be slowing going into the end of this quarter, being the second quarter of 2022. It's still expanding, but nonetheless, it is slowing. The second point is that what we are witnessing is price to earnings multiples are contracting. That goes back to investors are requiring a higher earnings yield because of rising rates, because of rising inflation. That's also impacting foreign equity multiples. Foreign equity multiples, however, have significant room to expand. Why? Because they're so much cheaper than US equity multiples and their interest rates are so much lower. So I do think that the second half of 2022 could see some recovery again if interest rates have peaked and energy prices have peaked. They could be friendly to bond prices and equity prices, but it wouldn't surprise me to see that if equity prices recover the back half of the year, the takeaway I'm trying to suggest is that I suspect that foreign equities may outrun US equities the balance of the year. So what does that mean? Well, in asset allocations, make sure you keep, particularly if you're a 401k investor driving your own account, make sure you keep foreign exposure in your account and make sure you own value stocks within your overall portfolio. Matter of fact, I say overweight value versus growth, as well as to the extent you've got commodity exposures, you can employ those as well, particularly if they're in the precious metals sector. Next point on inflation, as I've been noting, I think the elevated inflation levels are going to start moderating. And let me emphasize what I mean. We're seeing prints around 7.5% to 8%. I don't think we're going back to 4 or 3 or 2 by the end of the year, but I think we're going to go from 7.5 to 8, maybe down to 7 to 6.5 to 6. So in rate of change terms, that's going to be a marginal decline in inflation, which I think can be perceived to be friendly to both the fixed income market for the balance of the year, but it can also imply that central banks have done their job to try to get the inflation data to stop going higher and start to moderate, which could give them the opportunity to pause their restrictive monetary policy. Last point, again, on interest rates, I've already noted that. I do think the high that we saw this month at just under 3.5% in the 10-year could very well be the high that could lead to a rally in the bond market the back half of 2022. Having noted all that, as it relates to you, if you're a client, I want to let you know, always take this opportunity if there's any content from today's slides that make you want to go over anything as it relates to your account or your investment strategy that you have with me or any other advisors in our firm. Don't hesitate to take the opportunity to reach out to us. For those of you that are listening in that are not clients, if you want to take the opportunity to explore how some of these things could work in portfolio management for you, also don't hesitate to reach out to me to do that. I'm happy to do so at no obligation to you. In closing, I hope you and your family have a safe and memorable July 4th celebration this weekend, and goodbye for now.